Hello and good evening, everyone. Thank you for being here with us tonight. My name is Diana Cervera, and I am the Education Program Manager for San Diego, California Lawyers for the Arts branch. We're really excited for you to be here for tonight's workshop, Personal Finances and Taxes, Deconstructed and Constructed. As many of you know, California Lawyers for the Arts is a statewide nonprofit organization serving the arts community by providing a number of services across the state. And to share a bit more about what those services and programs are, I'd like to share a short video from our executive director before I introduce our speaker and we get started with tonight's event.
Hello, my name is Alma Robinson and I am the executive director of California Lawyers for the Arts. CLA is a statewide nonprofit organization that was founded in 1974 to serve artists and arts organizations of all disciplines with advocacy as well as services that provide support with legal and business issues. With staffed offices in San Francisco, Berkeley, Sacramento, Los Angeles, and San Diego, we provide several core services. First, we provide legal counseling to specialized attorneys who provide assistance with a variety of intellectual property questions, as well as contract reviews and negotiations and other important business issues. Depending on the client's financial status, legal assistance may be available on a pro bono or reduced fee basis. We also provide a specialized program that assists independent inventors and small startups with their patent applications. To help with situations involving disputes, we provide a range of alternative services, including negotiations counseling, mediation, and arbitration that can avoid the expense and hassle of going to court. Finally, we offer a full menu of educational programs that include workshops, symposia, and conferences on various legal topics for artists and arts organizations. Many of these programs are posted on our YouTube channel, and we encourage you to use these tools to educate yourself on the legal issues before you reach out for specialized assistance from our organization. Thank you for joining today's program, and please consider joining CLA on our website at www.calawyersforthearts.org so that we can continue to maintain our full range of services. Thank you.
Great, and as Alma mentioned, we do have a number of services available for those of you that are artists, small business, etc. So without further ado, I'd like to invite our speaker, Jesus Oba, and I'd like to introduce him, and then we'll begin tonight's presentation. So Jesus Oba is an enrolled agent and CPA whose tax practice is located in Shelter Island. He assists taxpayers and small businesses with taxes in San Diego and surrounding communities. Jesus has been a speaker with us a number of times, so it's great to have you back, Jesus, although usually we have these in person, so it's quite different this time, but thank you so much for being here tonight. We're excited to learn about taxes and managing our finances. So thank you.
Thanks again for having me. I really appreciate the warm invitation to present again. I really enjoy this crowd in particular because it takes me back to the roots of where I started my career, which is just helping small taxpayers make sense of, you know, what the overall circumstances are in terms of where their personal finances feed into their taxes. And in reality, the most typical, you know, cross-section of personal finance that everyone deals with annually is going to be on your income tax returns. So that's why the context is personal finance, but with the focus on your individual tax returns. I'll be focusing a bit more on your tax return, but some of this does touch on, you know, other aspects of personal finances. You know, the one thing that we have annually that touches on personal finances is the filing of an income tax return. But with people that wear multiple hats, such as many in the artist community, I think it's really important to just take a little bit of time to understand how it is that your tax return gets to be made by a tax professional such as myself, so that you can see and understand the back and forths, so that you have better context for the stuff to look out for. So that's the kind of the idea that I have as to why we start deconstructed to then construct all the little pieces that then come in to build your tax return. So let's get started here. We start with garbage because Sorry, I really enjoyed this joke because if you get started working with small business owners as a professional, they might come in with a box, and this box will have receipts. It has like notes, and it's very elaborate in the way that they organize it. But I mean, for my purposes, I very coldly say it's garbage. It's not. Those are primary source records that you must keep. But I thought it'd be funny to just start off with garbage. So it's not garbage. Those are primary source materials. But for my purposes, you're not paying me to organize things. You're paying so that I can get the information from you to prepare a return. So it's kind of distinct. So then I speak to the person. I say, hey, thanks so much for sending me 10 years of receipts and notes about what you have going on and what you've done and a bit of your personal bio, but it's not really useful for my task. So then I send them back the information, and what ends up happening, they send me some tax documents, which is useful. And so the example that I've built is a person who has a job. This is a mock W-2. So I really, worked really hard on the names of these companies. This is a working artist, so it'd be Unhappily Employed Inc. that they work for, right? So this is just the actual mock-up of a tax document, which was handwritten allegedly by yours truly. So sorry for subjecting you to my handwriting, but that's what, obviously a W-2 looks like. This is a summary of when someone receives wages from a company. This is generally what you can expect. It's just known as a W-2. It has box 1 is the total wages paid to you. Box 2 your federal withholding. Box 17 is the state income tax paid. And then box 14 is the state disability insurance that you've paid in throughout the year. But yeah, this is just a general mock-up of a W-2. So then the person tells me, okay, well, I'm also, I have some 1099 income. And then that's where it's like, okay, this person obviously wears a lot of hats. So then this first 1099 is from a certain entity called Directorial Debut here in San Diego. It's non-employee compensation for $7,000. So it's okay. Then I think to myself, okay, Directorial Debut might be some sort of business. I need to discuss with them what this is to get a little bit more of an understanding and understand that for 2021, it's the Form 1099 NEC for people that are not working as non-employment. So this is non-employee compensation. So this means that if you work for a company, but let's say you're not a W-2 employee, which this one was, and you just kind of do side work for them, they might very well give you a 1099 NEC. And also, as of 21, you also will have to start reporting this to the state of California. So not only does this get reported to the Internal Revenue Service, but it gets reported to California as well. So this is just a mock-up of a 1099 NEC from Directorial Debut. So I think to myself, and I make a note in my head, okay, this person may be involved in some sort of art. I don't exactly know. Okay, so then I move on, and then there's another 1099 from Drawings Galore. So this is a 1099 NEC again, which indicates that it's non-employee compensation. So it could be that they did some work for this Drawings Galore. And just from the names, I could just figure like, okay, so this might be even another activity. And okay, so it's the same thing, non-employee compensation of $3,000, state income, which gets reported at $3,000 as well. And then, yeah, so this is just another mock-up of a 1099 NEC with $3,000 of income from Drawings Galore. And then the third tax document that they send me is one from Sketch Inc. Again, it's another 1099 non-employee compensation. So they're not an employee of this company, and they receive $2,700 in compensation. And then it gets reported to California as well. So just if you're keeping track, we're now at a W-2, one W-2, and 3 1099s. So that's what it looks like for this person right now. So, okay, so then coming back to what this means, I would generally take it to mean that this person, one, is an employee and then has a couple of things going on the side. So this tells me a couple of things. One, that they probably spend most of their time working for the W-2 job, which is probably their full-time job or close to full-time job. And then they wear a couple of extra hats. So the extra hats that they wear, then I'd have a discussion with the client to try and figure out, hey, so what's up with these 1099 NECs that you received? Can you explain to me a little bit more about what they're from? And then generally the client will tell me, yeah, you know what? Like I direct a little bit. I do some freelance directing. And so I also, I do some drawings. And so, so we'll kind of discuss, okay, so these are like the three things that they do to earn income. And then they'll say, oh, but also I do like a couple of other things. And then I'll be like, okay, well, what are the other things and do they generate any income for you? Then it opens up a discussion as to whether or not something is considered a business activity or a hobby. So this gets really to be a back and forth discussion. And, I need to have some input from the person to try and understand what exactly the activity is, whether it's a hobby or an actual business activity. And this matters because, one, they didn't have any income from these other activities. Let's say that they have a real joy for gardening, right? So let's say they love gardening and they've redone some work in their house, let's say. And then I'll kind of think to myself, well, all right, it seems like you like gardening, but this seems more like not necessarily related to any business that I can see that you're actually doing. But the more that we talk about the gardening that they do, then the next thing that they say is, well, listen, I'm going to grow my garden because I am actually trying to sell my service of garden design landscaping. Then I think to myself, well, wait a minute. So you're telling me that not only do you work full-time, one, and you like have this director activity, and then which pays you money, then also you do this drawing that pays you money. But then you're telling me that you also dedicate a lot of time to this gardening activity because you want to do garden design and stuff. So they'll say yes. Then I'll start asking, well, okay, so how many hours do you spend? And do you eventually intend to make some sort of business or profit from this? And then they say, you know what? No, I just really enjoy doing this. And if it happens, then so be it. So then I think to myself, all right, so then we don't have to include this third activity of gardening because A, it didn't make any income, and B, I mean, the expenses would be questionable to take because there's no business intention for the gardening activity. So this is something that you have to keep in the back of your mind when you're putting on multiple hats is, hey, is this a hobby or am I doing this with the intention of making it potentially a business? So this leads into the area which is known as hobby losses, which have been a big area historically for the IRS to try and figure out if people are trying actually to pursue something as a business or if it's just some kind of recharacterized activity to make it business deductible. And so a lot of the cases were of this kind of fact pattern. It's like, let's say a group of doctors who love going to Del Mar to see the horse races, then decide, hey, you know what? Let's pool some money together and buy a few horses. We'll put it in a partnership and make all the business expenses look legitimate. So then the IRS will come back and say, well, wait a minute. You're a full-time doctor and you have your plate full with your practice. You work over 40 hours a week at this. You're at the horse racetrack maybe once a week, and you maybe see your horses twice a month. Yes, you've hired people, but this doesn't really seem to be a business activity. This seems like a hobby. And so a lot of the court cases that have come out in this area really test what someone's relationship is to the activity that they claim is a business. And this is more of an issue when these activities generate losses, which these court cases did. So what these doctors were doing was they were offsetting their wages or other compensation that they receive from their medical practices with the losses from their horse racing. So this is why, these tests now really come into play as much as they do. But that's kind of the context. And then bringing it back to the client situation, we'll kind of have this back and forth and trying to understand, if this is a hobby or if it's an actual business activity. And I guess my rule of thumb generally ends up being is if it feels like a business, you treat it like a business, then it's more likely to be a business. So then the kinds of questions I would ask the client would be, hey, listen, so show me your business plan for this gardening activity. Oh, I don't have a business plan. Okay, well, show me like what you have to like potentially explain your services. Oh, nothing. I just take people to my garden and I show them my garden. Then yeah, with those, just simple tests, I get the sense that someone's not necessarily serious about this being a business. And then we kind of just agree to leave it off their tax returns. But the tricky part with hobbies is, let's say that this client that I'm mentioning does get someone to pay them for designing their garden. Well, you have to pick up the income even if it's a hobby, but then if it's still treated as a hobby, you might not be able to deduct the expenses. So it's like, that's the IRS trying to make sure that you recognize and pay tax on all of your income. But because something is a hobby, then you only get to deduct expenses to the extent of any income. So in my case, what I'm just mentioning with this situation, the client doesn't have any income and only expenses. Then if it's a hobby, it's best to leave it off because those expenses wouldn't be deductible anyways. But say they did generate income, then you could deduct expenses to the extent of that income to get to zero if it's a hobby. So that's just the general rule of thumb. I'm guessing that this is applicable just simply because historically, when I presented for California Lawyers for the Arts, this has been a point that there's clearly a lot of hat wearing in this community, right? So there's a day job, and then there's a couple of things that one does to just kind of keep your art going. And so you're involved in the community, or to some extent, if you're not a full-time working artist, then that's kind of where all of this comes into play. So then let's bring it back to the other activities which do generate income, which is the directing and the drawing. So from there, I'll understand from them like, no, this is actually what they would like to be doing, but they can't generate enough work to support themselves completely from directing and drawing. So that's why they have their day job. And so that's kind of like the combination of general circumstances that you find someone who wears multiple hats. So you have to be honest with what your main, where you dedicate most of your time to then know how to classify everything else. So in this case, the teaching is what really takes up most of the time as a full-time job. Then the directing is sort of a side thing, and then the drawing is another side thing. But then because they generate income, I'm more inclined to treat those as businesses. And then therefore the next discussion ends up being, hey, I see that directing and drawing generates income. Can you explain to me, what you're doing to generate this income? And then this is when they start saying more things about how this is true, feels more like a business. It's like, yeah, I go to these directing networking circles. I put my reels out. I have a hosted website to show all my directed work. You see, that kind of feels already more like a business than the gardening thing, garden design, right? So that's kind of, it's very subjective, and facts and circumstances definitely play into this. And then the drawing, so then we'll shift topics to the drawing. It's like, okay, can you explain to me what's going on with the drawing thing? They're like, okay, yeah, no, I rent a studio, a separate space for my home to have all my drawing space and all my materials there. I pay insurance for my drawings because I do intend to sell them. I've sold a few pieces last year, and I'm published in a few publications. And yeah, I do these networking things, and I attended a few workshops. So already all of that sounds like, okay, this person's clearly taking the directing pretty seriously and taking the drawing pretty seriously, because it seems like they're really trying to make something happen and make that their main source of income. So those are the kinds of subjective things that I have to kind of work through to try and understand what it is that someone is actually doing to know how best to present their income sources to the IRS in their tax return. So it's very, it's not cut and dried, because you kind of have to ask a few questions. And so I would suggest to you that if you have similar circumstances, to also just go about substantiating the activities that you have to make them feel more like a business. It's like, well, let's say you're in some sort of visual medium. We'll make sure that your art's uploaded to a website, maintain the website, update your portfolio, have like a business vision statement, or like, you know, a bio that explains your work and what your rates are for commissions, things like that. So that clearly you've thought this through, so that when you present it to somebody, it feels like, yeah, it feels strange to say this being in the art space, but it feels like, okay, this person's clearly in the business of making this art, and it's a little bit more defined than, oh, well, it's just something that I do on the side, you see? Because that's where it could easily be misinterpreted by accountants as a hobby. And I have to tell you, the majority of accountants are terrible at talking, which is somewhat a distinguishing feature of myself. And they don't think to ask secondary questions, but I simply try to open it up with, okay, so what do you do with most of your time during the week? Can you explain this to me? And then I kind of, you know, work my way through that way, which is a little bit more circuitous of a route, but I think it's a truer representation of what exactly, you know, someone ends up doing. So that's a bit of context there that I thought I'd give. Let me see if there's any questions or comments at this point. Just feel free to add them and I'll check them as I keep going, okay? So that's kind of where I wanted to explain that in a bit of depth to then get to the next pieces. So this is the 1099 NEC. Now that we've talked about expenses, I asked them to provide me a summary of what it was that happened during their, 2020. So it's like, listen, here's the garbage. You remember this? I know, I keep reiterating. Here's the garbage that you gave me back. No, it's not garbage. It's primary source documents. Here is the stuff that you gave me. Can you please organize it and then give me a summary listing? And this is then what they give me. So then we have this really nice summary here for directorial income with the dates that they received payment. And you'll notice that they received payments in 2019 for a project that they had completed in 2020. So I wanted to start there because the directorial income, okay, so you'll notice two things. So how many 1099 NECs did we have for non-employee compensations that were related to directing? I think it was just one, right? Yeah, it was Directorial Debut was the only company that gave them a 1099 NEC. But then this summary has many more payments that they received for this activity, right? 1, 2, 3, 4, 5. And of these 5, I'm guessing these two, the 4,000 and the 3,000, would be the one that they received from Directorial Debut. Why? Because these add up to 7,000, right? So this one, 4,000 and 3,000, add up to the 7,000 from Directorial Debut. So then I'll ask and I'll think to myself, wait a minute, like it doesn't seem like everyone 1099'd you. So then this leads to my next point. Just because someone does not issue you a 1099 does not mean that it's not taxable to you. The rule is that if you've received income, you have to pay tax on it, regardless of whether or not they're going to 1099 you. So oftentimes people will say, well, I just was paid cash, no big deal. No one taxes cash. Unfortunately, that's not the case. Cash is most definitely taxable. So I then would see this and see that it doesn't match the 1099s. And I would say, hey, so I really appreciate you being honest about all the income that you sent me regarding your directorial activity. And I noticed that it doesn't match the 1099s received. And so you're doing the right thing. And I appreciate you, not making me dig to get this information, because the problem is if you don't show all of your income on your income tax return, then you might be in a situation where you could theoretically be committing fraud. And that's not the kind of space that anyone wants to be in. So I generally do tell my clients, hey, I really appreciate that. And I appreciate you being honest with me. And thank you so much for, listing out your income so clearly. But then I'll have a question. I'll say, hey, it looks like on the 27th of December of 2019, you received $3,800. What is that about? And they'll be like, okay, so that was like someone paid me for work that I was going to complete in 2019, then I'll ask them, okay, did you deposit it into your account into 2019? They'll say yes. And then I'll say, okay, here's the good news. The good news is you do not have to recognize that as income for 2020 because you received the cash in 2019. And they'll be like, oh, that's great. But then there's bad news. The bad news is they should have put this $3,800 in their 2019 return because that's when they received it. Okay, so then we're going to go to drawing income. And the drawing income summary is the same. There's 2 payments received, which is exactly for the 1099s. And then the client will say, okay, but I had some cash sales. And cash sales are not taxable, right? So then I'll say, no, cash sales are definitely taxable. So please get me the amount of cash sales that you have. And yeah, let's be sure to disclose all of your sales. So as I mentioned before, like cash sales are always taxable. Just be sure to always know that as long as you get paid for something, it's income regardless of how it gets paid to you, or even in the case of bartering, right? So let's say you decide to trade some artwork with a colleague of yours. Let's see, let's build this example up. Or you trade services, and it's pretty frequent that you see, it's like, oh, okay, well, I didn't receive any cash, but instead, like I did some art, some work for somebody, and they gave me 2 things. They gave me 2, let's say 2 photographs that have a fair market value of well, no one knows the fair market value, right? But it's like I did a small mural and then I received like these 3 pieces of artwork, 3 pieces of art, which, you know, they were selling on their website for like $600. But I mean, that's not taxable, right? And so unfortunately it is taxable because if they would have paid you, what would they have paid you? Let's say that the fair market value of the service that you know, the mural that you made, you would have generally charged $400 for it. So then that's exactly what that artwork is worth to you because that's kind of the trade-off there. And that $400 should have been included in your return as well as bartering income. So just be careful that these kinds of things are definitely taxable. I don't know how applicable they are, but they are definitely taxable. So just be sure to remember that. That's kind of the summary that I got. So when we have this conversation, then they go through all their stuff again and get me this. It's like, okay, well, listen, you need to get me everything organized. And then this is the second round after we have these exchanges, right? Directorial income, nice at 17,000. The drawing income, 7,200. So you'll notice it went up from 5,700 to 7,200 once they factored in all the cash they received or whatever. And then we would have talked about expenses, but I don't think I've touched on expenses here. So, and I wanted to mention a couple of things. So in your mind, you know, you should understand that with every hat you wear are expenses related to that kind of hat that you wear. So if you wear multiple hats, you have to kind of start thinking to yourself, okay, when did I generate this expense and what hat was I wearing? Everyone kind of is afraid of what is deductible and what isn't deductible, but the general rule is as follows. Anything that is ordinary and necessary to generate the income which you received and is usual in your trade or business should be deductible. So that's the general rule. And that means that the business expenses that I, as an accountant, have are very different to the expenses which a mixed media artist has, right? Why? Because, I mean, I don't need to buy pieces of metal, you know, distressed wood, old cars to tear up for parts to then make some sort of mosaic, right? I just buy paper and snacks and computers, right? Because I'm in the office and that's kind of what we do. So yeah, that's very different to like a mixed media artist who would then have to purchase all sorts of things to do, you know, whatever art, create whatever art that they make. So just keep that in the back of your mind. Anything that is any expense which is ordinary and necessary in your particular line of work should be deductible. So, and this also takes it one step further, and you have to think to yourself, this is very much based on context, right? As I was just explaining, because the business expenses of an accountant would be different from a mixed media artist, which would be different from, a musician. So yeah, all of these things are relative, and that's the general rule. So just keep that in the back of your mind. Anything which is ordinary and necessary to produce your income should be deductible, right? Within certain limitations, but that's the rule. So make sure to have that at the back of your mind and not think to yourself, oh, well, I don't know if this is deductible because like this is so weird. Well, it's only weird if it's not in context, right? So yeah, that's my point that I want to keep reinforcing. So then let's go back to the presentation. We're back here. So then I have this conversation with the client, and then I'm like, okay, so what expenses did you incur for that directorial work that you were doing? I had a set fees of $5,200 for someone to construct a few sets. I had some actors that I had to pay for $7,000. It's like, okay, great. That seemed perfectly reasonable when you're a director to have a set built and to pay actors, right? But imagine what I, as an accountant, would have to do, or I mean, would it seem reasonable that I have to build a set as an accountant or have actors around? I mean, unless I'm pulling off some sort of fraud. I mean, obviously not, but it's like not reasonable for an accountant, but for a director, it makes perfect sense. So then let's go to the drawing expenses. So the drawing expenses, let's say materials of $2,700, the studio rental of $2,400, studio insurance, $1,200, workshops of $3,000. Well, yeah, all that seems pretty reasonable to me. I'd have no reason to really doubt that that's reasonable given the context that it's related to drawing, right? So that's what I kind of want to tell you. Like, think of what it takes to make you be able to function in your medium. And then those are the kinds of expenses that you should consider deducting. And it includes things such as magazines that are trade magazines, workshops, the creative software that you use. So this is the income and expense summary that they then hand me. Then additionally, they'll tell me, you know what, I made an IRA contribution. And then I'll be, okay, great. So IRA contribution means that they're saving for their retirement. And this is where I want to segue into just talking about, the personal finance aspect of saving for retirement as someone that has multiple hats. So it's important to know that if you contribute to your retirement, this is tax deductible, one, but then also it helps you start saving for retirement. And so the segue is this: it's like the longer that you're saving, the better off that you'll be when it comes to trying to even get used to saving for retirement or anything else. And my main point is this: generally, the stock market gives back 7%. And what does that mean for all intents and purposes? It means that in 10 years, your money doubles. So without you doing anything that you save for your retirement today that's reasonably invested, conservatively invested, given what the market's been doing lately, at 6 to 7% will double in 10 years. So if you're going to retire in 20 to 30 years and you've been contributing consistently to some sort of retirement account, this money doubles without you having to do anything or contribute anymore. And the longer you let it grow, so by the time you let something, let's say you let $6,000 sit in an investment which gives back 7%, it doubles after 10 years, but then triples after 20 years. So look at it that way. It's just passive compound interest that is what the value is for investing for the long term. And I can't emphasize this enough, especially for self-employed clients, because one, I mean, everyone wants to be able to retire. So then, in some sense, just think about what you can set aside today. And it doesn't even need to be that much, but as long as you get in the habit of it, $100 saved today, 10 years from now is $200. But then 20 years from now is $600 for you just contributing today and leaving it there. So that's kind of what's important to understand, because that's what compound interest essentially does. And that's just something that happens without you having to think about it or anything. So it's important. I wanted to touch on that simply because I always like to see that people start saving for their retirement as soon as possible. The age of retirement for Social Security, full Social Security, is now 67. So if you start saving at 37, you still have 30 years to save for your full retirement with Social Security. And by then, if you contribute $6,000 a year, reasonably invested, here, I'll run that computation for you because I'm an accountant, and I'll even screen share it so you can see what I'm seeing, which is extremely exciting, I'm sure. But that's important. And I think that that's where, not enough importance gets placed on this, because it's tricky to save nowadays, but if you look at it from when you're retiring. Okay, so I'm going to show you the example that I just kind of mentioned. Assuming you're 37 and start putting aside $6,000 a year for 30 years annually, which is what the IRA contribution is. When you hit age 67, then you'll have saved $633,000 plus whatever your full Social Security is. So let me show you what that looks like in terms of the compound interest. So a lot of people's eyes are glazing over, but I just want you to get back down to the bottom here. And so the amount that you financed, this is an amortization software, so the terminology's off, but you've contributed $180,000 to your retirement, right? But then the amount of interest and the amount of compound interest or compounding that's happened is $453,000. So then that totals $633,000 when you retire. And so just for context, I'll then do this. Let's say you retire when you turn 67, which is January 1st of 2052. So you're 67 at the time. And let's say that you live until you're 90. So 90 minus 67 is 23 times 12, which is 276 months. So let's figure out what this amount of money is until you're 90. So, okay, not only do you get your full Social Security of like $2,100, let's say, you're going to get $4,597 every month until you're 90. So that's not a bad deal if you just invest it with the aim of getting something like 7% back. And so your retirement will look pretty, that's pretty cool, right? But that's what I mean. It doesn't seem like $6,000 is a lot until you let it compound for 30 years. And then before you know it, you're living off of $55,000 a year from the $6,000 annual contributions. And so you're doing that until you're 90, which is, pretty cool way to look at this is the bottom line numbers, which means you contributed $180,000 during your IRA contributions, and then you got back $1,088,796 throughout the course of you receiving that income monthly. And that's just this is actually what I do all day, which is like coming up with amortization schedules. So I think that that's really powerful for you guys to see. And hopefully this kind of makes a little bit more sense as to why it's so valuable to start saving for retirement sooner than later, simply because by the end of it, the stronger the amount of compounding interest is going to be 10 times the amount in this model, about 10 times the amount. And so, yeah, that's incredible, right? It's pretty crazy when you see it spelled out this way. And so this makes a lot more sense than just thinking, oh, I'll start next year saving for my retirement or something. Because every year that you're shorting yourself, by the time you're 67, it's worth so much more money than it would be today. So if you're at whatever phase you're in, please consider opening up at least an IRA to contribute, or if you have a retirement program offered to you through your day job, you have to at least and your employer offers some sort of matching scheme, that's money on the table that you're leaving. So make sure that you take at least, you make the amount of contributions necessary to get the full matching from your employers, because that's essentially wages and money that you're leaving on the table if you don't take it. So please make sure to start planning for your retirement and, more importantly, saving for it in whatever mechanism that you can, which is either an IRA, a Roth IRA. And the difference between an IRA and a Roth IRA is that an IRA is deductible from your income now, right? So you deduct it when you contribute, and a Roth IRA is not deductible. The contributions are not deductible, but then when you withdraw money after the age of 59, you don't pay tax on anything that you withdraw from your Roth IRA. So that's the difference between the two. I generally tell clients that it's better to do the traditional IRA contributions while you're earning income, so you get the tax deduction. And then when you retire, you're replacing your income with this money that you've already had tax deductibility from. And that's a little bit more of like an as case basis. So I just say that out loud because that's kind of the criteria that I think of when I'm trying to suggest to my client which kind of IRA to contribute to. I'll show you in the return that I mocked up where all of this comes into play. So from there, then I'll be like, okay, client, aspiring artist, let's see what your return looks like. So then it's this is what the actual return that's built off of will look like. So as you can see, on line 1 is the wages that they showed me. And then line 8 is 2,700. And that doesn't necessarily make the most straightforward sense because you're just like, well, how'd they get to 2,700? We'll get to that. Then there's the adjustments to income, which are 6,441, which don't really make sense right now, but we'll go over. Then the standard deduction of 12,400, something called the qualified business income deduction, which is 502, and then taxable income of 20,078. So then this gets us to here's the rub, right? So 2,212 in tax, plus 381 in other taxes, which I'll just spoil the secret. These are self-employment taxes. $4,277 were withheld in federal income taxes. And so what ends up happening? This actually generates a refund for this taxpayer of $1,684. So we took all the disparate, income things and we built up the return. And the good news is they get refunds. So there wasn't any need to fret about the cash income, you see? So this is what I mean. Like you have to kind of factor in all of the particulars in order to really try to understand what exactly happened with an individual. So again, let's start on the next page, which says business or income attached Schedule C's. Total nets out to 2,700, which is still kind of weird. Because this taxpayer was a teacher, they get a special deduction for under the adjustments to income for educator expenses of $250, which leads to half of your self-employment taxes being deductible of $191. Just take that at face value. IRA deduction, because they made a contribution to an IRA of $6,000. So then total adjustments to income, $6,441. Okay, and then this is the taxes, and as I mentioned, the 381 is from self-employment taxes. So another point, when you have a tax return, the first 2 pages of the 1040 are the summary of all the other schedules. So all the other schedules which we're going to review summarize the information which is here. So just be sure to remember that. So it's like the 1040 is the summary, and then all the schedules with the supporting information are behind it. So 1040 is the summary, and that's the most important one. So here's Schedule 1, which is just another part of the return and has deductions and other income and stuff. And then let's get down to the Schedule C's. Okay, so here we can see aspiring artist directing activity from her Schedule C, $17,000 in income. Expenses. Oh boy, all of these expense categories are zeros. And so a lot of people get frozen when they see, oh no, the kinds of business expenses that I have are not deductible because they're not here on this Schedule C. And that's not true. You have to then attach page 2 of the Schedule C, which is the other expenses. And as we mentioned, the set expenses of 5,200 and actors of 7,000 is what the 12,200 is. So they had a profit here from this business activity of $4,800. Okay, so then let's go here to aspiring artists drawing activity. And this is the drawing activity. Total income of 7,200. Cost of goods sold, which were the materials, of 2,700. Gross profit of 4,500. Okay. Then they had insurance for their studio of 1,200, and they rented a studio for 2,400. And then the other expenses here are 3,000. Let's look at what the 3,000 was. And that's the workshops and training. And this actually generated a loss, right? So it's negative 2,100. So then how is it that the 2,700 gets computed? Well, what's negative? Well, if you, okay, so this is a loss. $2,100 is a loss plus 4,800. So let's see if I can do this correctly. 4,800 minus 2,100 equals 2,700. So then let's look back at the tax return, and 2,700 should be what we have for self-employed income, which is correct. That's what it has. And so that's kind of what the overall example that I just, kind of put together gave you. So yeah, that's kind of based on those facts and circumstances, what that should look like. And that's the federal tax return. Then everything that's behind it on these pages is just going to be more computations, which support the other schedules, the 1040. So then this is the California tax return. And the main thing of note here is it pretty much reflects what the federal return has in terms of income. But California, obviously, tax rate is much lower. So it'll still be getting a refund back. Yeah, so that's the California return, which essentially just piggybacks off the federal one. That's what I wanted to do, is just build up, where the source materials of stuff is, the considerations, which you have to kind of take into account to then build a tax return to correctly reflect someone's activity. So I think that's kind of what the point of all of this was. Hopefully that was made a little bit clearer to you. That's kind of, it breaks down the process. And so it kind of puts a little bit more like, okay, well, this is actually what the process is and the individual details that build it. So hopefully that makes a bit more sense. So I have a question here. I have a 1099 NEC and a 1099 MISC. What's the difference? I do the same kind of work for both companies. So unfortunately, the 1099 NEC and 1099 MISC, the 1099 NEC is new for 2020. So that's just an indicator that that is non-employee compensation. So the person that issued you the NEC may have been more up to date with the changes than the person that issued you the 1099 MISC. 1099 MISC, you probably got treated as other income, whereas on the 1099 NEC, it's non-employee compensation. So that's probably what ended up happening. I made a purpose-built studio desk for my home studio. Is that ordinary and necessary since I just could have bought one? Yeah, it's totally normal. If you want to deduct the parts, that's fine. It's just that you just bought the materials and built your desk. So what you get to deduct is just the sum of the parts because your labor does not get added in. The labor is free, unfortunately. So you get to deduct all the raw materials, but nothing else. So yeah, it's fine. If that's, let's say it's a specialized kind of, let's say you're a mixed media artist and you need to make some sort of iron working station. Yeah, you build it with materials that you get, but you can only deduct the materials, right? It's not like you built a replica of this $10,000 desk and deduct 10,000. That's not the way it works. It's that you paid 2,000 for the materials and you assembled it, you deduct 2,000. So perfectly fine. Someone had a question regarding minimum revenue to be considered a home-based business. Again, there's no minimum threshold. If you received any payments and it's some sort of business that you have to consider, then I would suggest to you to consider it maybe if it's a hobby or not, to then understand like how you should treat it for tax purposes. How to estimate quarterly taxes when income and expenses vary. So these are estimated taxes, and estimated taxes are always based off your previous year's income tax return. So if you have your 2019 return filed, then you can compute some estimated taxes by rounding up on the amount of tax that you paid in 2019, round that up, and then divide that by 4. And that should give you estimates to make for 2020. That's generally how it works. But then you have to factor in some things like federal withholding if someone is an employee and has a W-2 where they have taxes withheld. So that gets discounted, and then you can divide what's left by 4 and then make the quarterly. So that's the best way of doing it. If things fluctuate wildly, then you probably have other things going on that you probably want to work with a professional on. So yeah, keeping in mind that you have to make your estimated tax payments. Otherwise, you run the risk of having estimated tax penalties. In what circumstance should I create a corporation rather than continue to work as a sole proprietor? I guess that really matters on the particular circumstances that everyone operates in. The general rule of thumb that I give is that if someone is fairly disorganized and not necessarily like the best with record keeping, because of being a sole proprietor is the most flexible, I would probably say that I don't think that they're ready to have a corporation, because with corporation, you have to be a little bit better with record keeping. So if you are good at record keeping and then are just strictly looking for other benefits, such as liability protection, then perhaps at that point, you might want to consider an LLC or a corporation, depending on what your exposure is. Let's say that you create big installations. So let's say you have like a 20-foot high installation that you built. You probably don't want to have that be done individually, only because you could be sued if something happens for that installation, right? And it wouldn't just be what your art business is worth, it'd be what you're worth individually. But if you're operating as an LLC or incorporation, that provides some measure of protection for your other personal assets. So yeah, that's the kind of things to start to consider. There's other tax benefits potentially to having corporations, but it kind of is a case-by-case basis depending on what the individual circumstances are and what benefits could potentially be, whether it be liability protection or lower tax rates. So that's that one. What can I write off? How to deal with international business expenses. Again, what can you write off? Whatever's ordinary and necessary for your particular business, which varies depending on what that is. International business expenses, just be sure you have good record keeping and it's related to whatever it is that you generated the income with, and you shouldn't have a problem there. How to deal with grants. All right, so grants are a particular thing where you need to understand the terms of the grant that you were given, and you're likely to receive a 1099 NEC for whatever amounts of cash you receive as a grant. Because the idea is you will be creating something with the money that they give you, which then means that you probably should be keeping receipts for whatever expenses you incur to create this piece of work that you've been commissioned to do. So the gross grant amount is generally the income, and then you have the expenses associated with assembling or building whatever it is that you're commissioned for. But grants are just that. They should be considered likely as non-employee compensation to then be able to deduct whatever business expenses you have against them. How to take advantage of most tax breaks. There's like a big misconception that there's tax breaks. And I don't know, maybe I've done this too long and I just don't necessarily see it that way anymore. But in general, I mean, the biggest thing to consider is that, is it ordinary and necessary in your line of business? Yes. Well, then it should be deductible. So I don't necessarily see that as a tax break. Maybe there's planning, such as contributing to an IRA that you're maybe making reference to. But in general, like that's the kind of thing where that probably does take a little bit more one-on-one time to discuss. If income fluctuates a lot, is it okay to average out the estimated tax payments over the 4 payments based on the previous year? Yeah, that's exactly the point of estimated tax payment. If you know, let's say you're 100% self-employed and you can just base your estimated tax payments based on your previous year's return, that's the nice thing. It's like regardless of what happens in the current period, your estimated taxes are based on the previous year. So unless your income goes up a lot, you should be okay when it comes April and you're preparing your tax return and you paid your estimated tax payments to be at least in the ballpark for what your estimated tax liability should be. However, I caution, let's say that last year you earned $50,000, but then for 2020, so then your estimates are based off $50,000, but then 2020 went gangbusters for whatever medium that you work in, and you had 150,000. Well, then in that case, you might have to start making additional tax payments to not be subject to underpayment penalties. But again, like generally, it's based on the previous year and you should be okay so long as you pay the whatever else that you owe for 2020 by April 15th of 2021. Just FYI.
How can I claim stimulus money that I should have received but did not?
Okay, so and the stimulus money, this is important. So the stimulus, if you did not receive your stimulus, then the way to claim it is through your income tax return for 2020. So be sure that when you're working through your 2020 taxes to make sure that if you did not receive your stimulus, to make that aware, make that very aware in your return so that you're credited that stimulus money when you file your return so that it's credited to you. Just FYI. Is there somewhere on the return that asks about the stimulus? Yes, there is. The stimulus questions are going to be on one of the schedules. I forget the name of the schedule, but if you did not receive your stimulus, economic recovery payments is what they're being referred to. So if you didn't, then they should be credited on your income tax return. I believe it's on page 2 of the 1040 to make sure. Yeah, it's on the credits area of page 2 of the 1040. So that's where the general credit goes. So be sure to take a look at there. Okay, so I think with that, the questions have pretty much been answered. That was the general gist of my presentation that I wanted to give you guys today. And I hope that you guys feel a little bit more informed. And so I can hand this back to Diana. And yeah, I thank you guys for making yourselves available.
Thank you, Jesus. Thank you everyone for joining us tonight. Hopefully your questions were answered. Well, thank you everyone for joining us. Have a great rest of your night. And thank you again, Jesus.